Hello, everybody. This is probably the 19th time I do this. Okay. I've been doing this all day. So forgive me. I just mess up a lot and I'm super bad at explaining things. So I'm just trying my best. Okay. I'm going to go through things slowly, look at everything that I already have set up. I've done this all the time. Okay. Today, I want to show you some basics of options. We'll go over it while explaining a strategy called the broken wing butterfly. Okay. And the stock that I'm going to do it on is on P&G. P&G is having their earnings. So I want to try to capitalize a little bit on the fact that people are going to make decisions based on those earnings. Okay. If you just a quick thought, if you had 100 shares of this right of this stock, you can do many strategies, but you would sell options so that you can make a little bit of money every Friday. Okay, and my goal is to make a little bit of money every Friday selling an option of some sort. Okay, you can probably make a lot of money off of buying options if you have something in mind that you want to, like a, let's like the Hertz deal. Hertz, you buy something and then all of a sudden there's this huge spike because of some crappy news, and you make that money and you sell it and you make that money and everything's good. But it doesn't always work out that way. I've already seen. I thought that that was the most genius play in the world, but it turns out that you just waste a lot of money, and I wasted a lot of money on it. But so what I'm doing are these small, consistent strategies that you can make money every single Friday. You can do one or two or as many as you want of these and see and hope that it works, or throw all your money away on one of them and see what happens. But the idea is that I want to just make tiny amounts of money. Okay, tiny amounts of money is, as I'm seeing right now, or as I've been going through it, it's like $20. Okay, that's what I'm expecting, a little bit more on this Friday alone, $20. But $20 is if I leave the strategy completely by itself. If I just set the strategy and I don't think about it and everything expires, it'll expire based on whatever price is left over. And that is a strategy and totally works. And if you're doing it using computers and algorithms and all that stuff, that's how you do it, because you don't want to think about it as you're doing it. But I like to look at the stocks and I like to keep myself ahead of it. So I like to be in the drama a little bit. So I find something to be dramatic throughout the day. I have my long-term play, as I've explained to you guys a million times. I have long terms that I'm not even looking at. I'm just investing in it, and hopefully, as if the market goes up or down, they're doing their thing. But what I want to do is make a little money during the week at something that I'm looking at constantly, and I could cry about it. Okay, that's just how I like to play. I enjoy that. You don't have to do that. You can set your money and not think about it by putting into long-term ETFs and all that kind of shit. And if you guys want to talk about that, we will. I can see that everybody's struggling a little bit with specific stocks, and that's fine. That's the way that everybody's going to be able to learn. Plus, there are a lot of companies that do actually increase more than the actual market. So if you win, you win. Whatever causes you to make money, that's what you do. Okay. And this is what's causing me to make money. So I'm going to do this, and I'm going to share this with everybody. Okay. So just a quick overview of options as I'm doing this. An option, buying and selling an option, are the two things that you can do with options. And when you buy an option, you're expecting the price to go in the way that you want it to go. I already have this set up here, and I'll explain all this later. But let me give you a quick what I would want the options to do. This is the entire strategy that I have right here, and this is the broken wing butterfly and all that kind of shit. But what I'm going to explain is each individual one. If I buy the 127, if I buy something, this is the profit loss graph, and tells you where it's going to go. So if I buy it, I'm expecting it. If it goes up higher, notice the price here. If I buy this 127 call, I'm expecting the price by July 31st to be at or higher than 127. I'm going to bring this down to 127. All right, I'm expecting that price. Notice it says here there's a 65% chance that it's going to be lower and a 34% chance that it'll be higher. Okay, so obviously I have a much lower probability here, not much lower, half lower. And if it happens to shoot up, then I will be gaining all of this money. I buy it. Look, notice what it says here. 731.36. This is the amount of money you would be gaining for every dollar value that it goes up. Obviously, here is the reverse. If it goes down, this is what you'll be losing, which doesn't seem like too much, because the most that you can lose is 100. If I buy it at 143, that's the most you can lose. It says here 170. So let's say I buy it at 170. That's the most I can lose, 170, right? But the most I can gain, here it is, 730. So this is a good strategy for somebody who is 100% sure and can lose the money that they put in, right? So if I know I can lose 170 bucks, no issue. That's no big deal. Okay, well then I'm gonna play 170 bucks, and I know that it's gonna have a shot up. Not only that, you don't want to do that during the week. You know what I mean? When you have 5 days for it, because every single day it's going to lose value. So it's not worth it to do it for a small term play. But if I set it for, freaking, I'll do it right here. I set it for. Look at the expiration dates. I could set it for October. I want it in October to shoot up to 127. Oh, look, it doesn't even have that because whatever. I want it to be higher than 125. I'm having a little bit of lag. Give me a second here. I don't know what's happening. It's probably freaking out because I shouldn't be putting it on the same thing. But the point would be the same. When you want to do long calls and you just want to have long calls, you need a lot more time. You should always have a lot more time. Shit crashed. Okay. This will show you the same thing. Long calls. When you want the price to go up, you're expecting the price to go up, you make that money. Long puts, you're expecting the price to go down, you buy a put, it does the same thing, okay? So when you're selling them, let me see if I can see just a shorting. All options. This is an options playbook, a pretty good set. So short call, just a short call, when you're bearish to neutral, okay? So short call means you buy at this price and you're expecting the price to go down. Even though it's a call, you're expecting the price to go down, you're selling it and you want to keep that premium. You don't want the price to go up higher. But the problem is that it's set, the profit is actually capped and the risk is actually unlimited, okay? When it comes to when you're doing short calls or short puts, risk is unlimited and the profit is capped at whatever it is that you sold it at originally, okay? So that's the basis. I'm sorry if you didn't understand it. I will explain it more with questions, okay? What buying is when you want something to go in your favor, you're buying it, you're expecting endless profit or whatever kind of profit, and you have a set risk. Selling is you're expecting the price to be under what you're selling and you have an unlimited risk and a set gain, okay? Simple. That part should be simple. And so what I'm doing is I'm going to be doing the broken wing butterfly, which is also called the skip strike butterfly. And the reason that it's called skip strike is because you're going to be buying 4 different options, or you're going to be getting into 4 different options. You're going to sell 2 of them and you're going to buy 2 of them. And the reason that you buy and sell these is because when you buy an option, you have positive 100 shares, okay? And when you sell an option, you have negative 100 shares. So if you buy 2 and you sell 2, you're at 0, okay? 0 is an interesting number to be at because you cannot do too much movement. And that's why when I buy this strategy, I just place the strategy and I run it, you don't touch it. You just leave it alone and let the price handle itself. You have an idea of what's going to happen. So you just let the price handle itself. Let me, while I'm here really quickly, be doing this. So what I want to do is set this up, but the reason the butterfly is cool, or any of these that involve buying and selling are cool, is because you can make money on the in-between if the things don't go the way you expect it to go, okay? And the way that you do that is a little complicated because you have to remember the net zero problem, okay? You have to always be at net zero because you cannot have negative without giving too much collateral, okay? You cannot sell an option without putting in money that they'll hold in case the option happens to spike up. They'll have that money already there, and that's how people get margin calls. When you have that guy who, when you're selling something, that's how you get margin calls. You can sell stocks too. You can short stocks, and they'll give you the money for it and everything. But if it goes the wrong way, you'll be paying a lot of money of the yin yang. And if we remember that kid that killed himself over $700 and something thousand, that was supposedly a glitch, but it was also, from what I read, a margin call that he had. And margin calls is that. This is the SQQ, not what I wanted. PFG is where I'm at. I wanted to show you guys, let me just set this really quickly, what I'm going to do. Okay. So the way that I'm going to do this strategy is that I'm going to buy a call at strike price A. And what I want, the way that I do it is that I want to figure out which one I want to sell. Okay. So strike price, the selling to a strike price B is going to be what I'm looking for. And when I look here, I see that the top here is 128. It probably will not go higher than that. That is a lie. I don't know if I've already done some analysis with you guys, but because I've done this so many times, I don't remember where I'm at. But the idea is that this is at a breakout point right now. We're at a point where it could shoot up if the economy is doing great. It's going to shoot up. There's no reason for it not to do. But where it's at right now is sort of like its peak. It has reached its peak. So I'm betting that it's going to stay within that peak. I'm telling you right now, I could be completely wrong. This is, a big thing. But when you do these strategies and you leave them as they are, the most you lose is a little bit of bread, and the most you gain is a bit more. So, so 128 is a price that I'm going to pick to sell. That's what I believe. The price will not go up. People are going to think that it's going to go up higher. Maybe something happens throughout the week, and including the earnings volatility, causes it to go up. So people are going to be buying it. And by the time they're buying it, I'm already selling it and making that money. Okay. Everybody wants to think that it's going to go up. That's good. I believe it's not going to go up all the way. So what I'm going to set is the selling price of 28. The strike price, I'm going to sell to open, two of them at July 31st and 128, and it's a call. Okay, I'm just going to leave the prices that are here because it's not important right now. And then I'm going to buy those two other ones. The first one is right underneath where I'm buying, so 127. And then the other one is two prices up from where I'm buying, two whole numbers, so 128 to 130. Okay, this is the butterfly right here, the broken wing butterfly. This is the full broken wing butterfly right here. And this is the expected on the 31st. So I expect it to be under 128. And when I look at this here, this analysis is telling me earlier this morning it was actually a little bit higher. So when I started doing this, it was higher. So this is constantly changing, and it's still at 77%, which is much less than where it was earlier, believe it or not. So I'm kind of afraid of that, because I do believe that there is an opportunity for this to raise up higher. And the most that I stand to lose if it goes up to if it even goes up to 130, the most I stand to lose is $92, which is pretty good. It's not that bad. I think it's $92 in total. $92. I don't know. I'm still learning how to read this particular graph, but notice here it tells you at the different ones. Okay, so this is each individual play and what could happen. This is just a long call by itself. If it goes up, it goes up. Notice, remember, this is also just a long call. Same thing. And then this is the short. Okay, it's the equal opposite. Okay, look at how much money you could stand to lose if you just shorted it by itself. Okay, 1,300, and the most you can get is $300 off of it because it was at 140 something or whatever, or even less. And the most you can lose is unlimited. It's unlimited. It's horrendous. So you want to make sure you cover yourself by having these things. And the way that they cover each other is simple. If I have this price at 127, right? When the stock is going up, I'm gaining the money, right? And so I'm gaining whatever's happening here, but I have a 128 call that I'm selling at. Once it passes 128, I'm already losing money on the one that I'm selling, but the 127 is paying for all of that raise. Okay, this is it's starting to go up. So down here was a 127, here's a 128. They both go up together, and they're covering each other's expenses. Once it gets to a certain point, it's too high. Though this is still, as you can see, it's a little bit higher than this, right? It's always going to be at this same range, like the same range. You have the 130, and if I had an extra hand, I could do it. Okay. But I don't have an extra hand, so this is what I got to do. This is the 128 in the middle here, 130 up top, and 127 at the bottom. This, if the price goes up, they're going to keep covering each other like this, and the same way if the price goes down. Okay, that's why you have two in the middle to cover each one of that. That's very simple. That should be that's no that should the math is there. I don't know how to give it to you too well, but here is the visual aid for it. Okay. This is how it moves. This is exactly how it moves. So that's pretty good. It covers itself in either which way. The only reason you lose is because you have to pay so much if you're selling. You have to keep paying because the options prices change based on the Greeks, which I could explain to you. I'm not going to right now. What I will explain to you in a minute is the theta or whatever. But so those prices are capable of changing, and when you're selling, you're going to be paying a lot more than the other things. When you're buying stuff, you're not getting as much money. Selling is always the game in options. That's what everybody wants should be doing to be making money. Long calls and stuff like that is just kind of like hedging a bet that you have, or or the vice versa. All of these are still hedges, but when you're doing these strategies, these are profit strategies. You want to make money off of these strategies, and there's a couple of them. There's not that many of them. This is the one that helps you play all angles of it, and I'll explain right now why. The reason this thing is so awesome, and in case there happens to be some sort of trend change or something that goes on that changes the way things go, is here it is. Okay, so this is how it looks on the chart. Okay, right now we're down here, and this is the amount of space that we have left until the 31st. I'm expecting it to be doing this right here. Okay, but let me draw you really quickly what it is that where the F in God's name. I don't know why I can't draw. Where the hell is the drawing button? Please forgive me for this. Here it is. Okay, so here's what I expect it to be doing. This is what I want it to be doing. Okay. So what happens is that if I'm buying down here, right? This is where I'm going to start selling. If it goes up, the two calls that I have that are positive are going to go up. They're going to raise in value, while the selling thing is going to technically raise in value. But for you, you want to sell it to open at a certain price, and you want to buy it back at a lower price. That way you can make the difference between that. Okay. So if I originally start selling it at 108 and I buy it back at 80, I'm making those 20 bucks that I have it there. And that's how you can make money quickly. No option is expected to be held to expiration, and that's why most options expire worthless. It's just a fact, and that's exactly why we try to make money off of that fact. It's just a statistical fact or whatever. So most people get out of the option ahead of time. And if you're selling an option, what you don't want is to be assigned, which means that somebody does buy that option and ends up closing it so that they can make the money, and then you have to pay that money. So when it's already above, you have to pay extra. When it's below, if it's not in the money, nobody's going to close it because it's not in the money. You're not making any money. But if it happens to be somewhere around the actual range, then somebody might assign it, and you have to pay whatever money it is, and you'll keep whatever's left over. Okay. So if it's not in the money at all, you get to keep that whole thing. If it is in the money, you only get to keep whatever the difference is. Okay. So the way that I can make money, if there happens to be some sort of change in the range, some change in the price, and it goes up or below for the selling and the buying, right? It's down here and it starts to go up. So I'm already making money off of the 127 call, right? Making that money. It's starting to go up, and the 128 is losing value. It'll go up to this number, but it's not losing value. It just stays at that thing. If I see that it has a chance of breaking out of this line that I have placed, this is just my analysis. It doesn't mean anything. It only means something to me, right? And if I'm doing it correctly, there's going to be a lot of people who are doing the same thing, and they're basing it off of the same thing, so I can make money from them using the same strategies. Okay, that's the thing you got to remember. A lot of everything that is programmed off of basic strategies. That if you learn those strategies, you'll see that people are trading the same thing, and you can kind of learn to do the opposite, or make money off of the opposite. Make money the way that everybody else is making money off of you. Right? So if it goes up, one is gaining value, right? So let's say I think it's going to break out or something like that, and I don't know what's going to happen. Maybe even for the selling point, I would rather do it up here, right? Because if I sell it, I'm going to sell it at the highest price that it probably can reach, and then I wait for it to come down. Now, Remember what I said about the net zero. You always have to be at net zero, or at least at positive. You cannot be at negative. If not, they're going to charge you a collateral for it, right? So I see that this price is down here and I buy it down here. If the price is going down lower, by the end of the thing, what I've seen so far, you have two choices. What I've seen so far is the two. Okay, maybe there's more. Maybe somebody else knows more than I do, obviously, but this is the two that I see. You want to keep the strategy going until the end because you want to make the premium off of those two that you sold. But the problem is, since they're offsetting each other, you might not make as much as you want to, or as much as it's reported, because you have these two calls that are there. Now, to eat both of them, you have to have the ones that you sold, the ones that you're buying. So you can always keep the ones that you're buying, but you can't keep the ones that you're selling. So if I think it's going to go up and I'm not going to make money off of the selling, and I'm going to break the opportunity, I mean, and have to pay up more, what you'll want to keep is the ones that you're buying, not the ones that you're selling. I've already learned to keep at least one that you're selling, so that that thing that you thought was going to happen, if it happens, you make the money. And I made a mistake on plug, thinking that it was going to shoot up, and in the end it was just hype and it shot back down. There's pump and dumps every fucking week, every single day there's a pump and dump somewhere, and it could happen at any price, at any stock. So what the interchanging, which maybe you play, maybe you don't play. I have been playing it this way to try to make more money off of this strategy, but for the most part, people probably don't do it. So when it goes up, and I want to make that premium, let's say that's why I would say to buy it up here. But let's say I buy it down here, and it starts to shoot up, and I want to close one of them to make that money. I would have to buy back the one that I'm selling, which is paying whatever it is. If it's at $100, you have to pay that $100. But then it closes that, and now you're at net positive 100. And if it shoots up, well, then it goes up, and once it's up at whatever value you expected, let's say it just has a quick pump or whatever, right? Not a big deal, and it's gonna shoot down again like it did on plug for me. It shoots all the way up here. Let me draw it out, and in a different color. It shoots all the way up here. When it shoots up here, you will want to have sold at least one of them. Like, you saw that something was going to happen, and you want to have sold one of them in the middle. Buy it back, Eliga. You buy it back in the middle, and then you'll be making all that premium on the way up, and then you sell that one. That's for the 127, right? Because it still hasn't even reached 130 or anything like that. We have one up here. This just in case something happens and the price goes all the way up here. Maybe you would rather wait until it gets to that point. So it goes all the way up here. It shoots all the way up here. And you should have gotten out of one of them, because the truth is that if it does shoot up here and you're selling it, maybe somebody's going to do the same thing. Okay, you're going to get a sign, and then you're going to have to pay that money, and it's not going to go back down. Most chances are that it doesn't. I don't know why. Maybe it's because there's more options out there selling than there are buyers, or maybe people hold it thinking that it's going to go, or maybe it's because there's a lot of computers that are buying and hedging. I don't know why, but there you do have an opportunity of getting a sign. It's just not that super high. Okay, so it comes up here. You had already sold one of the ones that you were selling. You already bought back one of the ones that you were selling, so that you can make the premium here, and probably whatever it is that you paid to get that option back, you will probably make it right here on this one right here. And then it shoots back down. And what you want is for it to shoot back down, but you'll be losing money off of this one. So you gotta find out which one it is that you want to sell. Maybe this one, the 130 costs now how much? The 130 costs now $54. But when it gets close to 130, when it's actually getting close to being in the money, maybe it's worth $100. So you can make the 150 there and not sell that one, but you'll have lost all of this money here. Even though I do believe the one that should be sold is the top one. When it shoots up like that and it comes back down, the one that should be sold is the top one, so that you can keep the money from the bottom one, because it'll always be in the money, while the other one might expire worthless. So you'll probably make more money keeping the one that's in the money than the one that's going to expire worthless. I don't know if that's true. That's just what I've been going through right now, and I will find out probably this week and see what happens. As of right now, the best idea is to keep it where it's at and to try to wait for something like this to happen. The same way, if it happens to shoot down, and it's going to come back up, right? If it shoots down and I'm selling at this price over here, I'm going to wait for it to come down here, and then I'm going to buy back the one that I was selling, and I'm going to buy it back much cheaper. So I'm going to make all that premium back, and I could probably sell them both. And but the 127 and the 130, by the time it gets down here, will be very cheap, and it will have lost all that value. So you better hope that it shoots up again so that you can make money off of those calls. Okay. Those are the two ways that it could go, obviously, out of the three. And what you want is for it to kind of stay in range and make whatever it is that you originally agreed upon. Now, let's look at buying it in Robinhood. I already have it here. And what it's going to cost in this particular case is going to be $20. So if I leave it alone, let me come over here real quick and be sure that I have the right thing. Okay, so this is what it'll cost. Obviously, it's not working out because the numbers aren't exactly the same, but in this case, it'll be 16. The risk is $84. That's why they'll hold the collateral just in case. So, it was a collateral of like $100, and the maximum return is 116, which is the 16 plus $100 that you make. So the only thing that I'm expecting to make if I leave it completely alone is $116. Okay, that's what I want to make by the end of the week. That's all I want to make by the end of the week. Now you can multiply this however it is that you want and make as much as you want, or you can do 2 or 3 strategies with different options or with different underlyings. You can do this whichever way you want, but the way that I want to do right now is just small, consistent wins, so that I can keep getting my ratio up and show that I'm kind of working out, and hopefully everything that I hit works. You know what I mean? Because that's the point. But this is the way that I would make that money at the end when everything is done. Okay, the 127, I sell it back, and if it's at let's say it's at, this is the 128, let's say it stays at 128, right, which is high, or 25 cents higher than what I expected it to be. I sell this back for $1.25 because it's one. Once it's done, there's no extrinsic value; it's pure intrinsic value, and it is exactly $1.25 in the money. So it's gonna be worth $125. You sell it back for $125. This lost 25 cents, right? Because it's up 25 cents times 2, 50. And this, when you sell it back, it's worthless because it stayed under 130. So it'll be $75, 125, 75, plus the 16 that they already paid me, and it'll be $91. So by the end on Friday, if I leave it completely alone and it stays under, if it goes up to 128, I'm not even expecting it to go up to one, it doesn't have to stay under 128. It'll be $91, 128.25. If it stays, I don't know why it shows here. Sell it back, and this will be worth this. Closing trade, $16. 66. If it's at 120, if it's lower than 128. That's interesting. I am also looking and learning, and somebody told me that this website isn't the best, but this is what I'm going to take as the money. I am not good at calculation, so I try not to calculate it. When I was first learning options, that was what they were doing on YouTube, and I was like, I don't know what any of this is. And it's hard for me. It's difficult for me, but I can kind of throw it. What I know for a fact is going to work out is what I envision when it comes to the charts. So I know it's not going to pass 120, or I feel it's not going to pass 128. So I want to sell it at 128. And this is a strategy that allows me to range myself depending on what happens. If I see that it's falling, then I can kind of, pick it up, and I got to be quick on it, but I can pick it up. If I see that it's growing, same thing. I got to be quick on it, but I can pick it up. And when you do these things, it's better to kind of like have a lot of hope and grounding in what it is that you want, because you will see the fluctuations happen, and it's going to be horrendous. But most of the time, it expires exactly where you expect it to expire. So this is the basis. I don't know if I went over everything, but I hope I did. Okay. And good luck with everything in life.